Well, good day to everybody. Welcome to our podcast series for business, brought to you by the Greater Fort Lauderdale Chamber of Commerce, the South Florida Business Council, the Greater Miami Chamber of Commerce, and the Chamber of the Palm Beaches. This is Dan Lindblade, President and CEO of the Greater Fort Lauderdale Chamber of Commerce. Today, it's my pleasure to welcome our guests from the law firm of Berger, Singerman. We have with us today David Black and Mitch Goldberg and Don Meyers to talk to us about the CARES Act. As most of you know, Congress passed a $2 trillion plus stimulus package, an emergency package that will filter out into the United States for individuals and businesses. And we're going to drill down on that today for the next 20 or 30 minutes, tell you a little more about that act and how it affects your business and your employees, how you might be able to patch into some of that money, and ask some more questions about exactly how it will filter out to you in the general public. So first of all, it's my pleasure, gentlemen and lady, to welcome you to our first podcast that we're having in the series. And David Black, I'd like to ask you a question just on an overview on the CARES Act as it addresses business owners or tenants in general who can't or don't want to, for varying reasons, pay rent in April. What answers do you have for them, Dave?
Sure. Thanks, Dan. So what's happening for me multiple times a day is various clients are speaking with my partner, Don, who's on this call, about the various loan programs available to them in the aftermath of this coronavirus pandemic, one of which, the most attractive of which, is the CARES Act loan programs. And after they hear about those options, they're coming to me with really two primary concerns. First of all, they're wondering what they do with their lease payments for their lease locations because they either don't have the cash flow to make those payments or they want to preserve cash for things like payroll and not pay rent. And so what we're seeing a lot of is really landlord responses that are all over the map. So some are just outright refusing to make rent concessions and abatements. Some are at the other end of the spectrum, providing abatements without much or any strings attached. And some are doing something in the middle, such as telling people that they will give abatements to our tenant clients if they can show that they've at least applied for one of these emergency loans, like the upcoming PPP loan that I know Don will talk about later. And some are saying you not only have to apply for it, you have to be rejected, that we'll only give you an abatement if you can't get it. And so the reactions have been all over the map. And so we're just dealing with them on a case-by-case basis and trying to get the best deal we can for our business operating clients that are leasing spaces from unaffiliated landlords. The other natural consequence of the calls that Don's having with our clients about these loan programs is a lot of our clients have existing debt facilities, whether it's term loans or lines of credit, almost all of which have a prohibition on additional debt, be it secured or unsecured debt. And so they're worried about, really being between a rock and a hard place because they need this money in some cases to stay open and not close down permanently. But they also don't like the idea of doing something that they know puts them in default on their senior and existing loan. And so the way we are reacting to that, frankly, depends on the program they're applying for. For example, in this upcoming PPP loan that Don will talk about under the CARES Act, those are going to be issued by banks, not directly by the SBA. And so in those instances, the natural tendency is to seek that loan from the existing lender, since there's an existing relationship there was existing underwriting in place. And so given that circumstance, most of our clients are comfortable, even if they don't get an explicit intercreditor agreement or an explicit waiver, most of them I find lately are comfortable if the same bank is issuing both loans with there being a technical default under the first set of loan documents because it's the same bank in both cases, particularly in the PPP case, because those are theoretically forgivable and the debt will go away. So those are the two issues I'm seeing multiple times a day emanating from the broader discussion of what loans can I get and what are the ramifications of them. I know that was a lot, so I'll pause there in case you have any follow-up questions to that, Dan.
Right, Dave, and you referred to the PPP. I'm assuming you're referring to the Paycheck Protection Plan loan. Is that correct?
Yeah.
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 So just for our listeners, I just wanted to make sure, because I know there's a lot of acronyms out there, and it's a new world we're playing in. So I wanted to make sure that we tell them exactly what we're working on here. But that's interesting information, good information. So a lot of things to consider for a business owner and with tenants. So as it relates, Don, to those interested in the Paycheck Protection Plan, give us a little more in-depth information about how that loan amount is calculated, if you would, please.
Sure. So what the Act provides is that the available loan amount is 2.5 times your average monthly payroll. They determine that payroll over the preceding year, and in the definition of payroll costs, they include things that go beyond just salary. So there are some benefits, including, for example, insurance premiums on health insurance policies, payroll taxes. There are a number of items that go into that definition of payroll cost. But the short version is 2.5 times your monthly average payroll cost is the amount of the loan that you could hope to get. There is a cap of $10 million, but you'd have to be a pretty substantial business for 2.5 times of your monthly payroll to get anywhere close to that $10 million cap.
Some of the business owners that I've talked to, small and medium-sized businesses, they suggested to me that they find it unfathomable that these loans could be forgiven. Can you fill me in on that?
Well, that's the best part of this program. A lot of people I talk to still find that a hard concept to believe, but that is in fact what the Act provides. So what the Act says is once you secure one of these loans, you can use them for the proceeds for a variety of different things. You can use it to pay payroll costs, mortgage interest, rent, utilities, things of that sort. When you get to the forgiveness side of it, what the Act provides is for all of those things in the categories that I just mentioned that you pay in the 8 weeks following issuance of the loan, that is an amount that can be forgiven. Now, there are some restrictions on that forgiveness, really in 2 buckets. If you reduce your total number or your average number of full-time equivalent employees in that period, your forgiveness amount can be reduced. Or if you reduce the salaries of your employees by more than 25%, your forgiveness amount could be reduced. Now, there are some nuances to both of those things that probably goes beyond the scope of what you're hoping to accomplish today, but that's the general framework of the forgiveness portion of the Paycheck Protection Program.
Thanks, Don. I want to go back to your first answer on how it's calculated. And you mentioned that there were some other areas that were included in payroll that some folks might not have thought of. But under these loans, let's say you get one of these loans, you're awarded one of these loans. And what can those loans proceeds be used towards?
Yeah, what you can use the proceeds for is broader than what the SBA looks at or the lender looks at for purposes of determining the loan amount. So as I mentioned, in determining the loan amount, you really are looking at that universe of payroll costs, salary, benefits, payroll taxes, et cetera. Once you secure that loan though, the line item, the list of things set forth in the Act that you can use the proceeds to pay goes beyond payroll cost. As I mentioned earlier, you can use it for rent, big line item for a lot of businesses that are suffering these days, mortgage interest, utilities. Now, all of those terms under the Act are deemed eligible costs, so there are a few restrictions on those, but generally, if these obligations existed, since, let's say February, I think the cutoff date's February 15th, then they typically are deemed eligible and you could use the proceeds to pay them.
Outstanding. A lot of flexibility in how Congress has set this up. I know that we've been seeing some other orders come through. We've been seeing, non-eviction orders. We've been seeing you don't have to pay property taxes in the state of Florida until a certain time. The IRS has said you don't have to file your taxes until the end of June or July, and also corporate tax filings have been also eased so that you don't have to refile those, which typically would be due in May. But Mitch, we also have seen some changes in retirement plans, and fill us in on what changes have occurred there.
Sure, thanks, and thanks for having us on. So, a lot of the changes that the CARES Act made to the Internal Revenue Code were designed to create liquidity for both individuals and businesses. One of the big changes that were made for individuals in the retirement plan context was the ability to take out up to $100,000 during 2020 from a qualified retirement plan without being subject to the 10% penalty for an early withdrawal. That money that come out generally is taxable income to the taxpayer, but the CARES Act has made it elective so that if taxpayer takes out $100,000 in 2020, he doesn't have to, or she doesn't have to, pick up the entire $100,000 in income in 2020. The taxpayer can spread it out ratably, over 3 years. So 33,000, 33,000, and 33,000 in each of 20, 21, and 22, so that get the benefit of the immediate cash infusion while deferring the obligation to pay taxes on it and have to shell out additional cash to the IRS. Now, there is another provision right there in the CARES Act that says the taxpayer who makes a qualified distribution from a retirement plan can repay that amount. And the way it reads is that if the taxpayer repays the distribution within 3 years of the first date of withdrawal, it's not taxable income to the taxpayer. Now that seems great, but it creates a bit of a funny timing issue, and I'm expecting Treasury and IRS to come out with some clarifying guidance on that. If you think about it, if I take out $100,000 distribution in 2020 with all good intentions that I'm going to repay it within 3 years, I'm not going to report it as income in 2020. But the way this economy is going, it could very well happen that the taxpayer who thinks he or she's going to be able to repay, in fact, is not able to repay within 3 years. And now that qualified distribution is taxable income, presumably in the year of receipt, is there going to be penalties and interest due in addition to the taxes? One of the little quirks that I'm looking at, and I'm waiting for further guidance to come out. One, just to zoom out for a second, the ability to take this early withdrawal and not be subject to the 10% penalty is only for eligible individuals who have been diagnosed with COVID-19, have a spouse or dependent diagnosed with COVID-19, or who have suffered an adverse financial consequence from COVID-19, such as being laid off or furloughed and so forth. It's not available to everyone.
That's a good point there that our listeners should be aware of. So many reasons why you wouldn't want to take money out of your retirement plan, because that's just what it's for, retirement. But for those folks who are affected negatively by this horrible virus. There are some options outside of what the government will be sending them in the form of a kind of a windfall, if you will. I will go back to David for a second. David, I mean,
Sure.
the overall plan that we see Congress rolling out, what the state's looking at. We were on conference calls today as chamber professionals talking about the impact on our economy. We've had over a 700-fold increase in the number of applications for unemployment insurance. We know our unemployment numbers are going to skyrocket. Businesses are laying off or furloughing employees. Some are shuttering right now. As it relates to your practice at Berger Singerman, what recommendations do you have for business owners at this time? What are the critical decisions that they should be making?
Sure, it's obviously a very relevant and important question. Most clients now are just what I call in survival mode. So the question becomes, on a case-by-case basis, what is most critical and time-sensitive? What is the issue most close in front of you that you need to deal with to survive? So for some, it's negotiating with a landlord. It's getting a pause in a debt facility that's coming due. It's keeping employees around. It all depends on a case-by-case basis, but those are three big ones, obviously. For some, it's supply chain issues and being strangled on the back end of their supply chain. And so what I'm just seeing, unfortunately, it's a grim time, is just helping clients on a case-by-case basis of figuring out what are the most time-sensitive issues needed to keep your business alive. Because, if you zoom out, this is not a fundamental weakness, a systemic fundamental weakness like we had in 2008 to 2010. This is a one-off, out of left field event that if companies can survive, they think they're not only going to do well in the future once we come out of this, but they're going to thrive because some businesses are going out of business. Some businesses have already gone out of business and there are going to be more. And so those who just survive right now are going to be better positioned to thrive once we come out of this because they're going to have fewer competitors and potentially be stronger than they were when they went into this. And so it's just all about survival. And that means a panoply of different things for different businesses. So we're just treating it on a case-by-case basis and trying to help clients sort through what are the most time-sensitive issues to staying alive and staying open.
Thanks, Dave.
May I add to that?
Please, Dawn.
Thank you. I think David hit the nail on the head. And in a lot of these, maybe it's not the best choice of phrase, but when we do these triage calls, one of the things we're trying to encourage our clients to do is just like David said, and that's to prioritize what their key concerns are, but then to step back and also take a holistic view as well. Just as a small example, there are some provisions of the Paycheck Protection Program that deal with layoffs, for example, but there's an interplay between employee retention and a different act that Congress recently passed, the Family First Coronavirus Response Act. So being able to take a global view of your business, the different needs, the different resources that are available, and the potential repercussions of any actions you're taking is so smart right now. So I just would encourage the listeners, particularly at this podcast, to make sure that they're not leaving any stone unturned. They're making sure they're looking at all aspects of their business and make sure that the decisions they make today don't cause them problems down the road.
Well said, Don.
And Dan, one thing I should... Oh,
go ahead.
I was just going to say, our goal is to help them get through this. Unfortunately, that's not happening for all of our clients, and it's not going to happen for all our clients. The one benefit we have of being at Berger Singerman is that our bankruptcy restructuring team is very well known, very well respected, and very capable. And so in some cases already, and sadly, I'm sure more cases in the future, we've had to do what we can, and if it's not enough, get them with one of our restructuring colleagues, even if it's not an in-court bankruptcy restructuring that's needed, some sort of distressed restructuring that team handles every day. And so yesterday I sent 2 of our clients to them because they don't think there's a better way out, and going that route is the lesser of all evils. And so we hope to minimize that happening, but unfortunately it is happening.
That brings up an interesting question, at least from my perspective, Dave. Do you think that this is an opportunistic time for an M&A activity, or is that just too draconian?
Without question. There are some businesses. I have a M&A deal that I just got called on yesterday from a manufacturer and distributor of, I won't say which, but a product that's in high demand now. So they are flush with cash, more so than they ever have, and they are going on a buying spree, buying not just competitors, but businesses in sort of ancillary spaces to grow and diversify beyond their core business. So in any crisis, it's a good point you raised, Dan. In any crisis, there's opportunity, and it's not always the best feeling opportunity, because there's a lot of, they're called vulture funds, right? There's a lot of room for people to take advantage of those in distress. But yes, there is absolutely that going on. In the deal I just mentioned, I'm on the sell side, so we're going to be acquired by one of these businesses that have benefited greatly from COVID and are flush with cash. But and my client's going to get an enormously high valuation for their business that a month ago they couldn't have dreamed of for a few years. And so, yeah, that's absolutely going to happen. And so businesses, whether they're doing well because of this catastrophe, or just businesses that happen to have lots of cash at every segment. Obviously, we deal in the middle market mainly, but at higher levels, over $100 million levels as well. There are going to be businesses that have the capability and the wherewithal and financial prowess to make strategic and opportunistic acquisitions. And there, to your point, there are going to be a lot of businesses that need that as a quick and clean exit, because it's better than the alternative.
Well, I want to thank all 3 of you for being on our podcast today, and I want to give you all a chance to make any closing remarks that you'd like to make. So let's start with you, Dawn. Any closing remarks?
Yes. Well, again, thank you, Dan, for this opportunity. The last thing I would mention is, while there's a lot of focus on the Paycheck Protection Program, and for good reason, given the forgiveness provisions in it, there are many other potential financial resources available from the federal government, particularly through the SBA. So don't be blinded by just the forgiveness. If you're interested in looking at those resources, look again globally to see which one of these programs is the best fit for you.
Thank you, Dawn. And Mitch, how about you? Closing comments?
Sure, thanks. I got my notes in front of me, a little shuffled. So IRS deadlines for filing and payment extended to July 15th as opposed to April 15th. The other thing, 2 quick hits I want to add regarding the payroll protection loans. Even if the loan is forgiven, there are some instances where it will be forgiven and excluded from income. Taxpayers should also be aware that even if the loan is forgiven and not excluded from income, there are other exclusions to treat cancellation of debt income as being excluded from gross income, one of which is the insolvency exception, which I feel a lot of business taxpayers will be facing as a result of the economic downturn in the wake of COVID-19. And then keeping with the quick hit on the tax side, the other big benefit that the CARES Act made, the big tax change, was changing the laws regarding net operating losses. Now the old laws have come back into effect for 2018, 2019, and 2020 that allows full NOL deductions plus carrybacks of up to not 5 years. So that's going to give a lot of taxpayers the opportunity to file amended tax returns to claim refunds and create some additional liquidity.
Great points, Mitch. And David, as a former director and a graduate of leadership Fort Lauderdale, why don't you close it out for us?
Sure. One of the things I love most about my job, which is mainly selling businesses, is that it's a fun environment to be in, right? You have a business owner that's built a business, they're going to sell it, put tens of millions of dollars in their pocket, and that's a fun thing to be immersed in constantly. This is the opposite, right? This is crisis management. This is dealing with the devastating effects of this virus and on businesses, and so it's the opposite of what I'm used to in my daily practice. But it's nevertheless nice to be able to help people, even if that help is not in the case of a wonderful merger and acquisition event. And so that's what we're doing. We're just, it's a different environment, but we're helping people, and that still feels good. Getting them from either bad to good, or from not as bad from an alternative scenario. So that's what we're doing, and would love to help anybody that needs it.
Well, thank you, Dave, and thank all of our specialists today from that legal law firm, Berger Singerman, top law firm in the country. So appreciate you being part of this podcast. And this is brought to you by the South Florida Business Council, the Greater Fort Lauderdale Chamber of Commerce, Chamber of the Palm Beaches, and the Greater Miami Chamber. My name is Dan Lindblade. I want to remind our listeners that you can go to a full compendium of information at www.ftlchamber.com, and that's /COVID-19. We'll be back with more podcasts in our series, and we look forward to having you listen in.